All right, everybody, super excited to have everyone here today and share some knowledge with everybody. Really appreciate you taking the time out of your day to join us. Before we get into the nitty gritty, I think one of the most interesting facts of business owners' financial picture is that 75% of their net worth is in their business. So let me just put this in perspective. If a client came to us and had Apple stock and it was worth 75% of their total portfolio, I would think they were crazy and that they need to optimize that. So in order to optimize it, we wanted to focus on the business today, specifically your business and specifically the entity and tax structure that you can optimize to leverage your business. Because again, 75% of your net worth, that's a lot of money. And it's a big percentage. So we wanted to have this webinar today and why it's so important for our business owners. I love teaching, I love sharing knowledge. So I hope that you guys can grasp some points today and implement them. We have quite a few people on today, so we have everyone muted. If you have any questions, please feel free to submit them in the Q&A functions. And also, as we go over these tax tips and entity structures, we are not accountants. It's super important to consult with your accountant and your lawyer before you make any changes. All right, so let's get started. My name is Andrew Life. I am the CEO, Chief Investment Officer, and Chief Financial Planner of Strategic Financial. I have my colleague, George Karras, who is also our COO. He is our MC today, who will be navigating us through the webinar. So he may interrupt us if there's any questions out there. And we'll try to answer as many questions as we possibly can while we're live. But if we don't, we'll follow up with you via email. And also to know that the webinar is being recorded. So our firm started in 1987, and we help our clients save on taxes, invest their assets, and we mitigate risk through different insurance strategies. In reality, we're really the quarterback for our clients. And we try to manage all the things that you do not want to manage from a business perspective and a personal life perspective because we tie them together. But what our clients value the most is that we become like their financial conscience. We try to reduce their anxiety and give them back their time because we all know as a business owner, just like I am, we're running 1,000 miles an hour. So we want to reduce that anxiety and give that time back. Currently, we oversee about $400 million in assets as of August 1st, and we have approximately 9 people at our firm. So the topics for today, what we're going to try and cover is the pros and cons of each business entity structure and what you should consider, the tax savings and retirement strategies that for business owners that you can implement, and then how LLCs, S Corps, C Corps, they're all taxed differently, so we'll go over that. We want to teach you how to coordinate your business financial situation with your personal financial situation. And then we'll quickly touch on the OBBB and how the new tax legislation impacts businesses. So the biggest takeaways from today is I want you to be able to have more information on how to choose the right entity type for you, tax strategies that you can implement to save you money, and how to adjust your income and super fund your retirement. So if we can grasp those three things today, I think today's a success. And if you can implement some of them, that would be super great as well. And that would be a success. So starting off, as you may know, there are S Corps, LLCs, and C Corps. And those are the primary ones that we deal with. So one question that we always get from our clients is which one is the right one for me and my business? So S Corps, they have some limitations. So no more than 100 shareholders or owners are allowed of an S Corp. They only allow one class of stock. Profits across your different owners of the company, they have to be distributed equally across those ownership percentages, and the owners must take a reasonable compensation as well. Okay. Now, C Corps, I'm going to skip all the way to C Corps on the far right there. They are similar to S Corps in the similar type of requirements. The main difference is the accounting and the tax ramifications of the entity itself. It does not limit the amount of equity owners, and it does not limit the types of classes of stock that you may have. Okay, so if you're starting out a business, I always say if you're starting out a business, my brother recently started his business, and I always recommend starting with an LLC because they are super easy to start up. It literally takes about 15 to 20 minutes to create your LLC for the federal government and at the state levels. You do not need to file a corporate tax return if you're a single member LLC. If you're a dual member or two or more equity owners of LLC, then you do have to file a tax return. So if you're a sole member LLC, you can just have it on your personal income tax return. So it saves you money on those accounting fees. There's an unlimited amount of shareholders with an LLC, and you can actually distribute the profit of your company unequally across your equity owners of the business. So what that means is like if you have a silent shareholder that is not really active in the business, you can actually divert that individual's compensation to yourself, the profit that would flow through the entity, which is super nice to have that flexibility. So overall, LLCs are the easiest to start up, have the least amount of requirements, and have the most flexibility. Then as you grow, so as you grow, the structure that you started out with may not be the structure that you end up with. Okay, because what you can do is you can always change your structure over time. So you can change it from one type to another, but when you move from an LLC to an S Corp or an S Corp to a C Corp or an LLC to a C Corp, there are tax ramifications when you make those adjustments. And it's very difficult to reverse them once you go from an LLC to a C Corp or from an LLC to an S Corp. It's hard to adjust those. So I always say it is super important to consult with your accountant and your lawyer when you're making those transitions or when you're changing it. Now, like I said, you can switch from an LLC to an S Corp. You can do that through a sub S election, and you can work with your CPA to make that change. Okay, so as we look at the taxes of the different entities. Okay, so let's start out with S corps. So S corps and LLCs. So S corps and LLCs and S corps, they pass through the profits to your individual tax return. So yes here, and yes here. And C corps, they do not pass the profits through to your individual tax return. All right, and when you do pass the profits to your individual tax return, those profits are taxed for federal and state income tax purposes. Okay. Now, with a C corp, you are taxed at 21. You have to pay 21% in corporate taxes, plus qualified dividend tax rate, plus your state income taxes. Okay. So we'll look at this in more detail in the subsequent slide. And then also on those profits, just so that you know, is that you have to pay Medicare and Social Security taxes, which are FICA. So S corps, the big tax savings with S corps is you don't have to do that. So any of that profit that flows through, you don't have to pay your Medicare or your Social Security tax. With LLCs, though, you absolutely do, and with C corps, you do not. All right, so let's go on to onto an example here. All right. So let's see. So I always say that like an example like this always speaks 1,000 words. So let's just say your company is generating $10 million in revenue. Okay. And then you have expenses of $9 million. Okay. The profit of your company is through an S corp is $1 million, LLC $1 million, LLC dual member LLC $1 million, C corp, this will be distributed as a dividend. Okay, so where it shows up on your tax return is really important. Okay, so from a tax perspective, S corps and LLCs, they will show up on your 1040, which is your individual tax return. And it'll show up under this adjusted Schedule 1 where you see $1 million. Okay. Now, for a C Corp, The C Corp will show underqualified dividends. Okay, so when we're looking at the taxes of this, the income tax rates are marginal, so they increase as you make more money. So for S Corps and LLCs, at making $1 million, your marginal tax bracket is 37%. So the blended taxes that you could potentially own is roughly around like $330,000. Where a C Corp, you have to pay the 21% in corporate taxes. You have to pay the dividend, the qualified dividend tax rate of 20%. So which can amount to approximately $380,000. Now, so again, C Corps can be more expensive from a tax perspective. Now, the difference between an S Corp and an LLC, now that is the big difference here, is that with the LLC, like we were talking about before, is that the LLC, you have to pay Medicare and Social Security tax. Okay. So when you are a business owner, you have to pay both the employee side and also the employer. So if you guys haven't been, if you've been employed by somebody else and you look at your pay stub, you'll see coming a deduction out of your pay stub of Social Security tax and Medicare tax. So Social Security tax is 6.2%, and then Medicare tax is 1.45. Now, as the business owner, which is why you see here in the calculation, I'm multiplying it by 2, as the business owner, you have to pay the other portion as well, because when you look at your pay stub, the employee is paying for half and the employer is paying half. So when you're the business owner, you're paying both sides because you're the employee and the business owner. All right. So when we're looking at it from an S Corp perspective, the S Corp, depending upon your income, doesn't have to pay a lot in Social Security tax, doesn't have to pay anything in Medicare tax. So your total tax could potentially be zero in distributing the profit out of your company. All right. Whereas the LLCs could be about $50,000, assuming $1 million profit, which is a lot of money. So one option that you could potentially do is you can reduce your salary. All right, and start taking a salary if you were to switch to an S corp, you could take a reduced salary underneath the Social Security wage base or the reasonable wage base from IRS guidelines, and then you can distribute the remaining amount of the profit through the company. So this will save you money on your Social Security tax and Medicare tax. And then one other way, just a quick tip is that you could also, if you own property that you're functioning out of, charge yourself rent because that also avoids Social Security and Medicare tax. All right. So if we're going on to the next tax savings tips, so this is a big one too. One of the most effective ways to manage your tax burden is by paying taxes directly through your business rather than through your personal checking accounts. Because if you're an LLC, you typically, or you're making a lot of money as a W-2 employee, you have to pay estimated tax payments to the state government. So one way that you could do it is a lot of states have this pass-through entity program where you can actually pay estimated tax payments to the state. So almost like your state tax liability, make it a business expense so it reduces your profit, and then you pay that to the federal government. And so when you submit your tax returns to the federal government, then it will reduce your profit by the amount that you paid. And so what will happen is that you can actually see where you claim it. So this is for the state of New Jersey because we live in the state of New Jersey, is that you claim this tax the payment as a credit on your state income tax return. Okay, so again, this is you're literally paying your state income taxes with the profits of your company or making it a business expense. All right, so some states that may, every state is different. So a lot of states that do that, New Jersey, Ohio, North Carolina, Alabama, they all do that. Okay, so this you can only do this though is if you're a business owner. So with S corps, you can do it. If you're a sole member LLC, typically you cannot do it. If you're a multi-member LLC, you can do it. And then if you're a C corp, you cannot do it. Okay, so another reason, another justification to potentially move to a S corp. Okay, so for non-business owners, they don't have this advantage. All right, so this is only for business owners. So one thing that I always, like I said in the past, is that you need to work with professionals to make sure that you comply with the state program and that you qualify. So work with your accountant to make sure that this allows you, so that this allows you and that you can take that deduction on your as a business expense and then claim it on your personal income tax return. And you'd be surprised how many clients have come to us that were not aware of this advantage that some of these states have. So if you need an accountant, we're happy to connect you with an accountant that is aware of these tax savings ideas that can help you implement them. Now, I always say that giving an example speaks 1,000 words, like I said before. So this is a live example, real example of if you were to switch from an LLC to an S corp. So a client of ours came to us and he was an LLC. And we looked at and worked with his accountant and said, okay, if you switch from an LLC to an S corp, what are the potential tax savings? So this individual, he had $1.3 million in profit. So as an S corp, you have to take some sort of reasonable salary. So he decided to take $350,000 as a reasonable salary, which is a lot. And there's a reason behind that $350,000 because it goes into the next subjects that we have. So he took $350,000 in a salary. So that reduced his net profit to about $989,000. Okay. So when he converted and he let all that profit through, he didn't have to pay additional money or additional taxes, Medicare taxes, which is 2.9%. So that saved him about $28,000. And then if you make over a certain amount of income, there's additional Medicare tax, which is 0.9%. So that saved him about $8,900. Then what we did is we implemented a 401k plan, and he was able to save $5,600 for the state that he was living in. And then for Fed purposes, he was able to save $25,900. Then we worked with the accountant to sign him up for the PTE program in the state, and that saved him $23,000. So when you add all of this up, that's $92,000 of potential savings, or savings that he had in taking and implementing these ideas, which is absolutely mind-boggling and crazy that by making these changes, you can save a large amount of money. It's a lot of money. And so let's just say you took that tax savings, that $92,000, and you invested it each year over a 20-year period. That would be a total savings of $4.5 million. Which is, if you could tell me that I could save you $92,000 a year and I could do that subsequently for 20 years and that turns into 4.5, I would take that in a heartbeat. All right. So as I mentioned, the client ended up putting money or establishing a 401k. So there are different tax savings vehicles that you can use. Okay. And a lot of you might be aware of these. So the purpose of these is, one, saving taxes for owners. All right. So save the owners on taxes. Okay. Second one is helping your employees, having them more obligation to help your employees save on taxes because it reduces their tax bill too. But it also helps them prepare for retirement. It helps you accumulate cash for retirement for yourself. And then in the market environment that we're in now, it's also a competitive advantage because we all know that finding good employees is hard to do. But once you find them, you want to retain them in a highly competitive marketplace. So the retirement plans that we're going to go over today, we're going to go over the 401k, we're going to go over SEPs, we're going to go over simples, traditional profit sharing plans, and then we'll end with cash balance plans. Okay, and that's like the coveted place to go. And then we'll go over how each one of these, or which ones are the most reasonable and would be the most applicable for the size of your business. So small, medium, large companies. Now, when looking at these retirement plans, it's super important that when you choose one, that you look at your census data. So what your makeup of your employees are. And so when we ever design or looking to implement a retirement plan, we always get the census data of your company. And the reason being is that their age, the tenure and length of the time that they've been employed with you, can impact what type of plan that you're going to incorporate. Okay, so we like to gather that data, and then we work with a third-party administrator to determine if which plan is the right one for you. All right, so let's go over the different types of plans. Okay, um, so with a set plan, you can put in $70,000 a year. All right. Now, the way that it works is that you have to apply a percentage, anything from 0 to 25, to the income that you're taking. Okay, the qualified income that you're taking. And so you can put in the greater of $70,000 or 25% of your income. All right, so you can adjust it from 0 to 25 year after year. It is completely flexible in the percentage, but you have to do it or you don't have to do it. Okay, so it's flexible in that in 1 year, if profit is down, you don't have to make it. The subsequent year, if profit is up and you want to contribute, you can do it. And then it's all Fed tax deductible when you make that contribution. All right. So one thing though on a set plan is that this is really made for a company where there are very few individuals or sole owners and you are the sole driver of everything, meaning you don't really have any other employees. And the reason why I say that is because if you were to grow your company and you're going to start off with maybe 1 or 2 employees, and over time you know that you're going to be growing, you're going to grow to 20, 30 employees, contributing a certain percentage, like 25%, is unsustainable because the cost just gets so expensive. All right. So think about this as like, let's just say you grow your payroll to $500,000. Well, if you were doing 25%, that'd be $125,000 of a contribution just for a set, which is a lot of money on anybody's profit or anybody's expense line item in their cash flow. All right. So if you had a payroll of $1 million and you were doing 25%, that would be $250,000 for SEP contributions, which is a ton. So when you think about implementing a retirement plan, it's super important that you pick the right one at the beginning, because if your employees get used to receiving a contribution of 20%, 15%, 25%, and then you switch to a new retirement plan, they're not going to be happy because they're used to getting that higher contribution amount from the company. All right. So it's very important to select the right plan. So again, a SEP is for individual entrepreneurs, individual business owners, or you have very few employees. I would say sub 5 employees. Okay. Now, profit sharing plans are very similar to SEPs. Again, you can contribute $70,000. Again, it's the lesser of 25% or $70,000. You can do it. It's all or none, but you can be flexible in who you contribute money to. I mean, at the end of the day, you have to contribute a little money to everybody. But what you can do is you can segment your employees out into different groups. So if you have a group of key employees and you have a group of non-key employees, like managers and support staff, you can create different profit sharings for each one of them, or different calculations for each one of them. Now, there is testing that you have to do, that it's more stringent in terms of the testing, because they want to make sure that you don't favor one group too much over another. But you can segment your employees out into different groups and compensate them differently. All right. So profit sharings, and I'll get back to profit sharings of when that would make the most sense to implement. Now, simple IRAs. So if you're starting out, I would say if you're starting out and you know that you're going to grow your business and you're going to add more employees, and you're still working on your business concept, you're still building up your revenue, simple IRAs may be the best way to go at the beginning. Okay, so with a simple IRA, you can contribute, you can defer from your salary $16,500 plus a catch-up of $3,500. So that would be a total of $20,500. Now, if you can see down here in this asterisk at the bottom of the page, there is an enhanced catch-up. Instead of the 3,500, if you're over the age of if you're the age of 60 to 63, you can contribute up to $5,250. Okay, as a catch-up. Now, if you're an employer with 25 or fewer employees, you can also defer up to $17,600 instead of the $16,500. Okay, and then you still have the enhanced catch-up of the 3,000, and you have an enhanced catch-up of $3,850. All right. So one thing to keep in mind is that you do have to contribute money to your employees' accounts. So you either do 2% of non-elective or 3% elective. So what does non-elective mean? Non-elective means if they are not making contributions, if they're not deferring money from their salary to the account, to their retirement account, you have to make contributions to them no matter what, if they're contributing money or if they're not contributing money. The 3% elective is you only contribute to their account if they are deferring money into their account. So non-elective is that even if they're not contributing to their retirement account or deferring money from their salary, you have to contribute money to their account. With the 3% elective, you only contribute, you only match if the employee is contributing money to their account. Now, the employee contribution is discretionary, so all employees, they don't have to contribute if they don't want to, but the employer has to make the match, and all of this is federal tax deductible. All right. Now we have the 401k. So I would say that the 401k is the enhanced version of a simple IRA. Simple IRAs are super easy to administer, not a lot of testing, not a lot of requirements. Traditional 401ks takes the playing field up a little bit. It requires more testing, more requirements, slightly more difficult to administer than a simple IRA. It's also more expensive than a simple IRA. The fees on the simple IRA are less. To run a 401k typically costs around $3,000 to $5,000 per year. All right. Now, with the 401k, you can defer $23,500 out of your salary plus an additional $7,500 for a total of $31,000. $31,000. Okay, $31,000. There's a typo here. Okay, so there is an enhanced catch-up as well if you're over the age of 50. All right, and the enhanced catch-up is that $7,500. So the matching contribution, it can be anywhere between 0 and 5%. So typically it's around like 3 to 4% because there's different safe harbor rules that you have. But typically it can be anywhere between 0 to 5%. And I would say the 401k is for those companies that know they're going to grow pretty quickly, and they're going to be adding additional employees. So similar to the simple IRA, can be designed to be flexible. The employee can decide whether they want to defer or not. And in most cases, there is some level of match. There's not always the case. You don't always have to have a match, but it does allow you to get over some testing requirements. All right. So, now the profit sharing, I wanted to step back to the profit sharing. One thing that you can do is you can combine some of these plans. Now, what you can do is you can combine the 401k and a profit sharing plan together. All right. Now, you can't combine like a SEP and a simple IRA together, but you can combine a 401k plan and a profit sharing plan. So when you're looking at how much you can put in, if you combine the two, you can actually put in $70,000 plus $7,500 for the catch-up. So a total of $77,500. Now, I call this the crown jewel, is when you can do the 401k, you can do the profit sharing, and you can do the cash balance. All right. So some of you in the cash balance plan, some of you may have seen recently a Wall Street Journal article, I think it was about like 2 or 3 months ago, that a lot of physicians put in, so they own their own practice, they put in these cash balance plans. Okay. And you can hyperdrive your savings. So in this example where we were just using the profit sharing and 401k plan together, you can put in $77,000. Now, I have a client, this is a real life example where we established a 401k, a profit sharing plan, and a cash balance plan. The business owner was able to add and contribute $279,000, of which he gave $65,000 to his other employees because you have to give some contribution to your other employees. But he was able to retain for himself $213,000. Okay. So that is a lot of money just earmarked for yourself in 1 year, but also the tax savings on that can save you thousands, tens of thousands of dollars. All right. So it's always important to consult. Oh, and one other thing is with the cash balance plan, you want it makes most sense to install a cash balance plan when you have reoccurring revenue because you have to commit to funding the cash balance plan for a minimum of 3 years to pass like the IRS's sniff test. Okay. So it's always important to consult with the right financial advisor or the right accountant and right TPA to make sure that you design the plan correctly and choose the right plan. All right. So just to recap really quick on the tax savings tips before we move on to the one big beautiful bill. Overall, we want you to investigate if you have the right entity structure, especially if you're an LLC or a C Corp. Okay. And if you're not using that pass-through entity program, see if your state allows it. Ask your accountant. And then the next thing is identify the right retirement plan for you and your business at this current juncture. All right. So happy to help out as well. If you guys want to bounce any ideas around, we're happy to do that as well to help you steer you in the right direction. All right. So let's go on to
Hey, Andrew. Hey, Andrew, if I could jump in real quick, we do have a question. So on the different retirement plan options that you laid out, those are available whether you're an S Corp, LLC, or a C Corp?
That is correct. Yep.
Okay.
Yep.
And then one other question, and you just touched on it, on that PTE that you talked about, the best way to find out if your state is that just to speak to your accountant, or is there other ways that folks
Yeah.
can
So you
find
can
out?
speak to your accountant, or I mean, like sometimes you can Google it and or Chat GPT it and see if it comes back with results. But typically, it's your accountant would know the best um, as whether the state has it or not.
Great. Okay. Thanks for
All
those
right.
questions.
Yep. So with the one big beautiful bill, which was enacted in July, a couple of things that were great about it were for business owners specifically, is that it made permanent the qualified business income deduction, QBI deduction. Okay, so for business owners, and depending upon the entity and also the type of sector or business that you're in, you're able to deduct 20% of the profits off of your personal tax return. Okay. So that was a big one. It was supposed to sunset at the end of this year, but now it has been made permanent, which is super great. If you're thinking about, onto the next topic here, if you're thinking about selling your business and your business qualifies for the 1202 tax treatment, so what the 1202 tax treatment is that if you sell your business and you're a C Corp, then it eliminates any gains that you have to pay. So it gives you a credit up to $15 million. So if you're going to sell your business for $20 million, for federal tax purposes, you wouldn't have to claim $15 million of gain. You would only have to claim the $5 million gain. All right. And so that in this bill, it went from $10 million to $15 million. So it increased. All right. So while we talked about the benefits of a S corp throughout today, it makes sense you can switch from an LLC or an S corp to a C corp prior to the sale, and you have to do it 5 years prior. Okay. So it's super important that you work with a lawyer and you work with an accountant before you make any of those entity changes. Because there are tax ramifications that you can potentially incur by switching from entity types. All right. There is so one other thing was the 100% bonus depreciation. So this bonus depreciation is for qualified capital investments. So if you're investing in equipment or software, it allows you to deduct that expense immediately instead of amortizing it over multiple years, which was the case before. Now, the last one here is that the immediate expensing of R&D, so research and development cost. So before you had to amortize that over a 5-year period, and now you can expense that in the year that they occur, which is super great. All right. So I just wanted to thank everybody again for joining. I really appreciate you taking the time out of the day. I know that you guys are super busy and that your time is valuable, but um, I hope that we're able to provide you some nuggets today. A little insight into what we do and to bring this back full circle is that if your business, again, makes up 75% of your net worth, it's super important to optimize your business and the way that it functions. So there's many things that we can assist you with. Throughout your journey of owning the business and also planning personally. Because what we do as a company is we combine the two. A lot of private wealth or financial advisors will just focus on you personally, where we try and combine the two and optimize on both on the business side and personally. So we consult on the business front, and then we also consult on the business front and also on the personal side as well. And one thing is that I think that is one of our not that's one of our core differentiators, but also we have a 7-month financial planning process that is super in depth. All of our clients typically would go through this process. Some do, some don't. Um, but the ones that do, and a majority of our clients do, the one piece of feedback that we always get is how in depth it is and how much we cover and how we dot our I's and cross our T's to make sure everything in your plan is appropriately addressed and that you have a plan to where you need to go. So as clients think about whether Strategic Financial is the right platform or the right firm for you, we always like to, and how we help business owners is we like to ensure, okay, do you have the right entity structure? And we work with your CPA and lawyer to do that. How we can potentially save you on taxes and put more money in your pockets. We have an outsourced C-suite for companies that are large or companies that are emerging or trying to go larger, that for additional resources. So we have a outsourced chief financial officer, an outsourced chief marketing officer, an outsourced chief revenue officer, and we have a plethora of accountants and lawyers that are very proactive. I mean, one thing that we had a lawyer or accountant that we were using previously, and they were just somebody that we gave our numbers to, and they would just give our tax returns back. And I wanted somebody who would be proactive in our tax planning. And so we coordinate and strategize with those accounts on an ongoing basis. We will help you look at your profit and distribution of your income through your business from a benefits planning perspective. We look at your fringe benefits that you're offering yourself and also your employees to help retain those individuals. And then lastly, we help with business continuity planning. So in the event of your death or disability, you put your blood, sweat, and tears into your business and you should be compensated for it. So we don't want it to make, all that work that you've done, we don't want to make it all for nothing. So we help design a plan to get you compensation for that on that. And then also we help clients and business owners sell their business. So we find people that potentially buy 100% of equity or a portion of the equity, and then design the whole buyout process there. So happy to help in any of those ways. And if you have any specific situations, or you want to bounce any ideas off of us, we're happy to help. I'm a no pressure type of person. So if you just want to have a conversation, happy to do that. We'll be sending you an email after this. So feel free to respond with please contact, and we'll reach out to you to schedule a time. Always, I really appreciate you guys taking the time. If you want to, we're on Facebook, we're on Instagram, we're on YouTube, we're on LinkedIn. So feel free to follow us on there as well. Um, to learn about different ideas that we're sharing, because everything, and we're sharing situations and examples of clients that we encounter all the time. So again, thank you so much for joining us today. And make sure when before you make any changes, do anything, consult your accountant, consult your lawyer. So again, thanks again. Hope you have a wonderful day. Have a great Labor Day weekend, and we hope to hear from you soon.